This week again has proved to be the classic push and pull. We've certainly had the pull of decent corporate results, and we'll talk about a couple of businesses that are continuing to do very well. But the other side of the equation remains the macro picture, and the picture that continues to emerge in Europe, and the concerns for higher interest rates. And at the moment, the market, as I say, is continuing to experience quite choppy trading conditions. The FTSE 100, as we can see from this chart, failing to break out of this range. We've actually sort of slipped down to the low end of the recent trading range, but still to some extent in what I call that stabilised period post the August shocks that started in as I say, in August in Europe. So I think where the market is at the moment is that it fully understands the problem that Europe has. The question mark is what real impact is this going to have on economic growth. Evidence so far suggests that forecasts for 2012 will come down. However, in light of that, how well will businesses fare? And so when you speak to two sets of fund managers, I think that the sort of macro guys, the guys who look at the top end, have serious concerns about what is developing in the interest rate environment and economic environment. But the bottom-up guys, the guys who look at businesses, are finding it hard to get bearish because they're looking at businesses that seem to be trading quite robustly and see their way or navigate their way through these difficulties. And that, to some extent, is what's driving the stock market. So it's really undecided which direction it wants to turn, but in the interim, it is going to prove to be quite choppy. Now, we mentioned Europe, and it has to continue to feature in our podcast the charts of European debt. I've tried to summarise sort of three key stories here in European debt onto one chart. So what we're covering here at the top end are the two charts relating to the 10-year yields for Italian debt and for Spanish debt. And I think how the story has evolved over the course of this week. Naturally, Italy is a very big economy with 1.9 trillion euros of debt outstanding. But the other one to come along fairly quickly behind is Spain. And Spain is now at record highs for its 10-year debt into the new European environment. Both of these levels are economically unsustainable. But Europe does have, to some extent, time on its side. So, for example, if Europe has to refinance $300 billion over the course of the next 12 months, well, that represents, let's say, 1.16% of the outstanding debt. So this is a problem that is evolving over time. Whether the markets are going to give them that much luxury of time is going to be a matter of course over the next few weeks for more radical action. But these two areas suggest that really the only thing that's stopping that movement into ever higher territory at the moment is the ECB. And the ECB, every time they do move into the markets and start to buy these bonds, we see yields coming off, and that does allow stock markets to at least breathe easily, even if it's only for a very short period of time, and we're measuring that by hours, not days or weeks. Now, the one that I think we just got to keep a bit of an eye on at the bottom here is France. France is the AAA rated country. And these yields are starting to move higher at the moment. As I mentioned last week, we're not anywhere into alarmist territory of say 6 or 7 that's represented up here by Spain or Italy, but nevertheless it is a concerted trend, and we've all seen this particular story before play out, that once things are underway they become a fairly self-fulfilling prophecy. And I think that's one that could well influence over the next 3 or 4 weeks if that continues to widen. There is another chart that I'm not going to show, but is worth keeping an eye on, is the spread between the French and the German 10-year paper. Those spreads are widening out. It's the same with Spain. Spain has now moved very much towards 500 basis points over, and that was the level which I think made the 10 o'clock news on the BBC pick up and take notice. So those are the macro positions, but how's that influencing the currencies? Well, I would just point out that the euro is beginning to resume a slightly softer trend. It's been a constant debate as to why the euro is so strong, and some people have been saying, well, it's because a lot of money is being repatriated back into the euro from overseas, so therefore the strength that we've seen in the euro recently is more defensive than a positive position. However, we are starting to see a little bit of resumption of euro weakness here at the moment, so again, just an early warning there as to something that could be developing in the currency markets. Now I want to finish off really just with the other side of the coin, which is the strength of businesses, and wanted to highlight in the large cap space Vodafone. This sort of fall that we have seen here is largely technical. Vodafone is a big dividend yielding stock, and this week the dividend that was taken out of that stock was just over 7 pence per share. So if you adjusted for that, well, that stock would still be very much towards the high end of the chart. And so for all the drama that's been taking place in markets at the macro end over the course of the last 12 months, you've got big solid blue chip stocks, the dividend stocks, really outperforming very well at the moment, and looking set to continue to trade well. And I also wanted to highlight a mid-cap stock which is really receiving some very good attention from investors and the press alike, and that's Oxford Instruments, reporting another good set of results this week. This is a continuation of a 3-year plan from Oxford Instruments that is delivering good value for shareholders, and you can see that share price really just back up to the all-time high. What does this company do? Well, it's at the very cutting edge of medical, scientific and industrial research. It provides the toolkits for these new areas of applications. These are going to be the applications that Britain will need to start to resurge in terms of its business confidence. So I think that's a company to highlight. It should almost be a model of a business that the government should use as to what we really need to start to produce in order to get economic recovery back in the UK on track. And a lot of its growth is coming from those markets such as China and India, is where the new growth is coming from, and where I personally believe businesses are best positioned to navigate these difficult markets by exploiting growth opportunities such as this.